Welcome to the Stock Market Morning Prep video for Thursday, July 3rd. Quick admin note, next video will be Wednesday, July 9th. Just taking a few days off of producing the videos early morning, sleeping in a little late. Anyway, yesterday markets did absolutely nothing, really had a big pause day, to be expected from a prior move up. And of course, coming into a risk event, having the ECB policy decision, and then of course the speech, and then we also have the non-farm payrolls that are due out this morning at 8:30 in the U.S. Just also another quick admin note: today markets are a half a day, so we don't even have a full day of trading today. I do suspect the first hour of trading will be, if anything, decent, and then that's about it. And pretty much most of the interns and Tier 2 traders are just going to be watching positions, doing absolutely nothing. And I think Monday's going to be dead as well. And then most of the traders and market participants come back Tuesday. And then we'll really see where this market goes. There's ADP report yesterday showed some good numbers. So if that's what's to come, then markets just continue to go higher. And S&P 2000, here we come. But let me run down the numbers. Dow Jones down 20, Nasdaq down 92 cents. Dow Jones was up 20. I apologize. S&P up $1.30, and the Russell down $6.45. So you could see there's no activity. Very, very few stocks moved yesterday. If you were right in front of it, if not, you scanned it, you looked at it, you missed it. That's how slow it was yesterday. It was very, very slow. And again, it's to be expected. Nothing wrong with it. Actually, it puts a feather in the bull camp, knowing that we do have now sort of a pause day here, and then we'll see where we go. I'm going to run through the indexes just to kind of recap where we are going into next week, because they absolutely mean nothing this morning. Because if something were to change for the worse, then obviously this analysis I'm showing you is not going to work. So just take it with a grain of salt for today, only because we have this big risk event. All right, so now we have the Japanese yen again showing weakness yet again. We had nice movement to the upside, and then of course we failed, and now we're back under this Fibonacci cluster. Okay, now is resistance again. Now obviously we're still in this ascending triangle at the apex again. So this has been chopping around all of 2014. So let's see if this gets a chance to break out to the upside and or to the downside for that matter. Now we do have a bullish pattern here, so we would be looking for a breakout to the upside. But it just seems that this Fibonacci cluster has been really capping this move. And we don't forget, we also have the 200-day moving average just above it as well. So going to need a lot of work. But anytime you see the yen weak, you will see a bid under U.S. equities, okay, and worldwide equities for that matter. All right, so let's take a look at bonds. Bonds actually is doing finally what it really should be doing, is selling off. When you have a bid in U.S. markets in equities, bonds should be selling off, or at least showing some signs of weakness. And we did not have that, obviously, all of June, and definitely didn't have it since from March low up until the end of May. We're consolidating here in a channel, as you can see, and then now we're back into this channel again. So this was a bull flag, broke down. So I still think that bonds are in the short squeeze, and bonds are not like equities, remember. So it doesn't just say you squeeze and then it goes for 3-4 days like it did here. But I think it pauses, then I think it goes higher again, and then it pauses. But I do think this 1618 extension will be met at one point, unless something really, really dramatically changes. Because remember, when you have markets extended at these areas, and I'll show that to you in the chart, you have to be wary about money flowing out of equities and going into certain other safe haven, such as utilities, staples, and healthcare. And that's what most of the money has been flowing. The balance is speculative money going into U.S. equities. So when speculative money runs dry, and they're the worst, because what happens, they're the first ones to go, and they go at no cost. They hit bids, they sell stock, it doesn't matter. So that's the worrisome part of it for me, when you have spec money in this market. And that's really what you have here. You don't have true, obviously you do have mutual funds, hedge funds that are investing, but when you have a lot of the speculative money come in, They're the first ones to go real fast, and that's when you have that waterfall sell-off that we really don't want to see. All right, equities, U.S. equities. We have the E-mini S&P contract, as you can see, quite bullish. We have the 8, the 20, the 34, the 50, and of course the 200 sitting all on stacked up one another. Couldn't get any more bullish than this. We have exceeded the 1618 extension. 2000, here we come. We're only less than 30 points away. And I say we get there. There's no reason. If we're this close, why not get there? And then we would reevaluate it. And then you get the 2618, the big 2618 extension way up here. Does it get there? I would think so by year end. I don't think anytime soon. But I do see 2000 being touched. And then obviously we would reevaluate again where the market goes. But in the meantime, look for stocks that are basing. Look for stocks that have sold off already and now have re-triggered some buy interest, because what happens is you're going to get market participants that really don't want to put money to work way up at these lofty levels. So they're going to go back to stocks that and sectors that were out of favor and now are back in favor again. Okay, again, like we talked about with the builders, selective solars, selective banks, selective technology stocks that have been beaten up, and I showed them to you yesterday. They are all still very well valid. Okay, take a look at the diamonds. Diamonds, same thing here, just playing catch up. The diamonds are the weakest of the 5 that we follow, but again, playing catch up, and I think it does hit the 1618. There's no reason why this market can't do it. IWM took a little breather, rightfully so. Look at the big move it had since May, and now it has now challenged the previous high from March. And of course, the extension is the 1272, which would be our first now major extension after playing catch up in the IWM. And I do think it gets there. Qs, same thing. We are now looking at the 1618 extension. And a lot of big cap tech is doing well and has done well. Some are now a little bit extended. I think Amazon, if you look to play big cap tech, I don't play it, but Amazon looks like a breakout to the upside. So keep an eye on Amazon.